Welcome back to the Deep Dive. You know the drill by now. We get our hands on the kind of institutional research that, well, that actually moves markets, and we break it all down for you. And today, we're wrestling with a real masterclass in tactical trading. This is the Reserve of KING-KAMBUF Financial News and Reports magazine, weekly market digest and investment analysis.
And it's dated November 21st, 2025.
Exactly.
You know, this document, it's basically an institutional cheat sheet. It's built for traders who operate with a very high level of discipline.
Right.
So our mission today, it isn't just to, read you the news. It's to really synthesize the market context, pull out the highest conviction trading ideas, and I think most importantly, internalize the strict, the non-negotiable risk rules that KING-KAMBUF is built on.
Yeah, that risk part is key.
This is a snapshot of the market in a moment of, I'd say, extreme tension.
And that tension is the perfect place to jump in. Because you just look at the surface. If you just look at Friday, November 21st, it looked great.
Yeah.
It was a celebratory bounce.
Yeah.
The Dow surged over 493 points. That's up 1.1%. The S&P 500 gained almost a full percent.
Yeah.
It really felt like, risk-on sentiment was back heading into the weekend.
But that's the trap, right? If you fall into that trap of only looking at the Friday headline, you miss the brutal reality of the full week.
Completely different story.
Completely. The S&P 500 still finished the 5-day period down a painful 2.0%. And the NASDAQ, it just got hammered by tech selling. It had the largest decline, losing 2.5% overall.
Wow.
And the KING-KAMBUF analysis, it's really clear on this. They don't see this as some random dip. This is a deliberate tactical pullback. It's a consolidation phase after, that exceptionally powerful run we saw all through 2024 and into 2025.
Okay, so we have to unpack this. Let's dig into the anatomy of this really volatile week right away.
Let's do it.
So how do we, as informed observers, reconcile that massive Friday bounce with such severe weekly losses? It just feels contradictory. Was Friday just noise, or did something really shift?
It was a crucial shift, but the weekly loss that confirms the underlying pressure is still there. That big daily swing, it's explained by a couple of things. One is end-of-week short covering.
Okay, so traders taking profits.
Exactly. Traders either locking in gains from their short positions or just minimizing their losses before the weekend. But the other part was a definite tactical rotation. That Friday close, with the Dow up 1.1%, it signaled that the risk appetite hadn't vanished.
It just moved.
It had simply relocated. And the technical report, this is interesting, it noted that market breadth improved dramatically on Friday.
So more stocks were going up than down.
Way more. Roughly 450 of the S&P 500 stocks were advancing. And that suggests that while the big index numbers, they were depressed by the sheer weight of a few giant stocks, which we'll get into.
Right.
The majority of the market was actually finding its footing. It was finding a floor.
So the move wasn't uniform at all. The indices themselves were kind of distorted by the pain from earlier in the week, but under the surface, sentiment was trying to recover.
That's a perfect way to put it.
And to understand where that recovery really started, the report says we have to look past the usual megacap names and focus squarely on the Russell 2000.
The Russell 2000 was the absolute headline story on Friday. It surged over 3%. It led all the major benchmarks.
And that kind of move, it's never random.
Never. This movement is profoundly significant. The Russell 2000, as you know, it's made up of smaller, domestically focused companies. Its performance is highly sensitive to the economic outlook and, critically, to interest rate expectations.
So when small caps reverse that sharply.
It's the market forecasting a much stronger, sort of closer-to-home economic environment. It's a huge tell.
And there it is. That's the link. Their surge is being fueled by these strengthening hopes for a December Fed rate cut. And we can actually quantify that hope directly from the KING-KAMBUF report.
Exactly. The analysis explicitly states that the market is now pricing in a 45% probability of a rate cut in December.
45%. That's not insignificant.
It's a massive driver. Even a few percentage points change in that expectation can move billions of dollars. And for small cap companies, which typically rely more heavily on variable rate debt or shorter term financing.
Yeah, this is a game changer.
It is. The prospect of lower borrowing costs can fundamentally change their entire profit outlook overnight. Cheaper financing allows these companies, many of which are growth-oriented but maybe not yet consistently profitable, to just aggressively fund their expansion. And that explains the rush into these economically sensitive stocks on Friday.
So the Russell 2000 wasn't just rallying on its own. It was leading a kind of tectonic rotation in the market. And the report tells us this sentiment was already building up steam even before the opening bell.
Yeah, the pre-market activity analysis, it really reinforces this whole rotation narrative. You had futures across the board that were kind of mixed, reflecting some global uncertainty. But the Russell 2000 futures, they were leading the charge. They were up a decisive 0.77%.
And that's the market tipping its hand.
That was the market signaling its intentions. The institutional money was flowing into domestic risk assets, confirming that this whole small cap rotation narrative, it was real and it was actionable.
And when you drill down into the specific pre-market movers, you get even more detail on where that fundamental strength was being rewarded. You saw names like GPS, which is Gap, and BJ's Wholesale Club, showing resilience.
Consumer and retail strength right there.
Exactly. But the real standout was Intuit, INTU, which I think reflects that software can still be resilient, but only if there's a strong AI angle.
And conversely, this is just as important. The report flagged weakness in other software names like ESTC, that's Elastic, and VEEV, VEEV systems, before the market even opened.
Okay, so what does that tell you?
It tells you that traders were proactively rotating out of those pure-play software growth stocks, the ones that maybe missed on AI integration or were facing deceleration fears, and they were rotating into fundamental consumer resilience in these rate-sensitive domestic names.
So the whole technical landscape was shifting in real time.
Dramatically, away from last month's, high-flying growth darlings and toward value and stability, all of it underpinned by these rate cut hopes.
Okay, that makes sense. So shifting now from the indices to the actual market sentiment, we have to talk about the VIX. The volatility index, or as everyone calls it, the fear gauge.
Yes.
Because despite that powerful rally on Friday, the VIX level is, it's the ultimate sign that institutional traders, you have to remain highly disciplined right now.
This is where we go from understanding what happened to understanding how to trade what happened. It's a critical distinction.
Right.
And you're right, the VIX did slide sharply as the market rallied into Friday's close. However, that final print of 23.85 is the number you have to focus on.
23.85.
And KING-KAMBUF analysts, they zero in on the 5-day change metric, which was a massive, plus 35.87%.
Wow, a 35% weekly increase in volatility. That just tells you the degree of panic and uncertainty that was dominating earlier in the week, especially during that sharp sell-off on Thursday.
It's a huge number.
But what does VIX 23.85 practically mean for someone who's actually putting on trades?
It means you are absolutely not in a complacent market, not even close. VIX readings below, say 17, are generally considered complacent. The report even notes that 1 year ago, we were sitting at 17.16.
A completely different world.
Completely. At 23.85, we are deep into what's called a moderate volatility regime. And this mandates a fundamental change in your trading tactics.
How so?
For professional traders, it means the risk of getting whipsawed by sudden intraday reversals is incredibly high. So KMU strictly requires its traders to use significantly wider stop losses on all their positions.
You have to give your trades more room to breathe.
You have to. You cannot afford to use tight stops that are meant for a low volatility environment when the market is this choppy. You'll just get stopped out constantly, even if you're right on the overall direction.
And that elevated VIX, it naturally dictates the kind of sector rotation we were just talking about. When fear is high, traders flock to resilience.
It's a textbook risk-off signal. Look at the sectors that were leading the charge on Friday. It was healthcare, up 1.2%, and consumer staples, up 1.1%.
The classic defensive plays.
The classic defensives. Why these two? Well, healthcare demand is generally inelastic, right? It doesn't really matter if there's a recession. People still need medicine.
Sure.
And consumer staples, think toothpaste, soap, basic food. Those are non-discretionary purchases. They're strength signals that investors are prioritizing predictable cash flows and resilience over, high-flying cyclical growth potential.
And the report specifically calls out the momentum in these defensive names. They highlight Eli Lilly, LLY, and Johnson & Johnson, J&J, as stocks that are trading near their 52-week highs.
And LLY is such a key example here. It's premium defense meeting secular growth. Its strength is tied to the massive ongoing demand for the GLP-1 drug class.
For diabetes and obesity treatments.
Right. And this isn't a cyclical trend that's going to fade. It's a demographic and technological revolution that offers years of highly predictable, accelerating revenue. J&J, on the other hand, it just provides the stability of a diversified, massive healthcare anchor. These stocks act as capital preservation vehicles during times of uncertainty.
So on the flip side, the tech sector, which has been the primary engine of this market for, the last year, it saw really muted gains on Friday, only managing to get up about 0.5%.
And technology is clearly labeled under pressure in the analysis. This is critical to understand. The sector carries, approximately 28% of the S&P 500's entire weight.
It's huge.
It's huge. So that muted gain, it signals that while the indices bounced, money was actively rotating out of technology and into defense and small caps. The analysts at KING-KAMBUF, they believe this valuation normalization phase is necessary. It's healthy after that spectacular run tech had in 2024 and 2025.
And this brings us to a really crucial structural point that's detailed in the report, which is the index concentration risk. This explains why the Nasdaq dropping 2.5% for the week felt so extreme.
Yeah, the sheer weight of these mega caps just completely distorts the overall index performance. Think about the S&P 500. The top 10 stocks in that index account for nearly 39% of its total weight.
39% from just 10 companies.
It's incredible. You've got companies like NVDA at roughly 8%, Microsoft around 6-7%, Amazon at 3-4%, and the Nasdaq Q100 is even more concentrated. The top 10 names there make up roughly 53% of the index.
Wow.
NVDA is nearly 10% of that index by itself. Apple is another 8-9%.
So the profound insight here is that when just one or two of those names, say NVDA or Microsoft, faces a bit of a consolidation period, the impact on the entire index is just disproportionately massive.
Huge.
A 10% pullback in just 3 or 4 of these stocks can single-handedly drive the entire Nasdaq down 2.5% for the week, even if the vast majority of the other 90-plus stocks are flat or even up.
Precisely. And that structural risk is why KING-KAMBUF emphasizes risk management based on individual stock volatility, not just on the index averages. If you're holding a passive index fund, you have to understand that you are implicitly taking on extreme, concentrated risk tied to the valuation health of a very, very small handful of companies.
That's a crucial realization for anyone thinking about long-term allocation.
Absolutely.
Okay, let's drill down now from the macro environment to the individual stocks, because that's where the clearest signals of market preference really start to emerge. Let's start with the stocks hitting new 52-week highs.
The list of new highs, it just confirms this rotation we're talking about into specialized quality and defense. As we mentioned, Eli Lilly, LLY, remains paramount. It's trading near $1,060, and it represents the market's willingness to pay a real premium for fundamentally driven secular growth.
We're past the hype phase with them.
We're well past the hype. This valuation is now underpinned by hard clinical data, by real projections for their leading GLP-1 treatments, which are, they're transforming entire healthcare markets globally.
And outside of healthcare, we also see strength in a name like the TJX companies. TJX. That's interesting because it reflects a very specific consumer trend.
Yes, it does. TJX, which is the parent company of TJ Maxx and Marshalls, shows that consumers are still spending, but they're becoming intensely value conscious.
Because of inflation.
Because of persistent inflation. Off-price retail thrives in this kind of environment. The strength in TJX confirms that discretionary spending is shifting toward discount channels, and that makes it a kind of defensive winner within the broader retail sector.
Now let's look at the flip side, the 52-week lows. This list tells us exactly which areas are suffering the most pressure, suggesting the market just believes valuations got way too stretched.
And the focus here is clearly on established enterprise software. You've got Salesforce, CRM, and Adobe ADBZ both testing their annual lows.
And this is more than just a general tech pullback.
It is. It indicates an intense scrutiny over software subscription models. Investors are starting to question whether these companies can actually maintain the high growth rates that are required to justify their multiples, especially as generative AI starts shifting power dynamics and potentially creating new competitors.
So the post-pandemic cloud euphoria is finally wearing off.
It's hitting these names hard, and the data backs this up. KING-KAMBUF's summary of bar chart data, it shows that new lows continued to significantly dominate new highs across all the U.S. exchanges, even during Friday's big rally.
That is a really important technical footnote for the overall market's health.
It's the most important one. Despite the huge point gain on Friday, that underlying pressure, the process of shaking out weak hands and correcting these overextended valuations, it's still actively happening. Until that balance of new highs versus new lows shifts positively, you really can't say for certain that the correction is over.
Okay, let's move to the most emotionally charged part of the market.
Yeah.
The top daily movers. This is the realm of speculative mania, high-risk capital, and just explosive volume.
And the clear winner here, the name that was dominating all the news feeds, was Mobile Health Network Solutions, ticker MNDR.
And what a move.
It just exploded. It gained over 83% on 78 million shares of volume. This is highly speculative. It underscores that despite all the pressure in the broader market, there is still a massive appetite for these high-risk, high-reward plays, particularly in emerging healthcare tech or, AI-adjacent plays.
And these moves aren't driven by fundamentals?
No, not at all. They're typically driven by a sudden news event, momentum chasers, and heavy, heavy retail interest.
The report mentions other names in this speculative space, like VSA and AIIO, all showing these similar massive volume spikes and percentage gains, often in the penny stock world.
Right. This is capital chasing the highest delta, the highest potential return, often with, frankly, zero regard for proper risk management.
Which is why the KING-KAMBUF playbook, as we'll see, only includes one speculative trade and subjects it to the strictest possible risk rules.
You have to. Now, you contrast that chaos with the top losers, which often signals genuine fundamental or operational trouble.
And we see some familiar names here again. Elastic, ESTC, and VEEV systems, VEEV, featured prominently.
Yeah, these cloud and software companies, they're facing these growth deceleration fears. It confirms that thematic pressure we saw with CRM and Adobe. Investors are just ruthlessly scrutinizing quarterly reports for any sign of slowing growth or increased competition. If the market even smells a growth hiccup, the stock is just instantly punished.
And we also saw continued weakness in names like VinFast Auto, VFS, and Bitfarms, BITF.
Yep, that indicates the persistent troubles in the electric vehicle sector, at least outside of the established leaders, and the expected volatility in crypto-related stocks that just follow the broader swings in token prices.
Okay, so looking past all that volatility, the report makes a point that the strong Q3 earnings season is providing a crucial buffer for the market. Let's look at the positive reports from the last week that help stabilize sentiment.
The foundational health of corporate America is strong, and that's a major counter-argument against any, doomsday scenario. You look at BJ's Wholesale Club, BJ, they posted strong results, an EPS beat, and they raised their full-year guidance.
Which gives you confidence in consumer health.
Exactly, and the durability of that discount retail trend.
But the report from INTU, INTU, offers what might be the most interesting insight into the future of technology investment.
Absolutely. Intuit didn't just beat their estimates, they guided solidly higher, and they specifically credited the rollout of new AI features that are integrated into their financial products.
And that is key.
It's so key. It tells the market that AI is no longer just a concept that's confined to NVIDIA's chips or Google's large language models. AI integration is now a mandatory requirement for all established software companies if they want to maintain high growth and their premium multiples.
So if you aren't integrating AI to make your customers more efficient or to help with acquisition,
you're falling behind. And that valuation premium that you used to enjoy, it will erode fast.
And if we zoom out from the individual companies, the overall Q3 picture is actually very robust.
It is. Roughly 82.6% of S&P 500 reporters beat their estimates, with blended EPS growth estimated somewhere between 14% and 15% year over year.
That's a strong backdrop.
It's a very strong fundamental backdrop, and it's the single most compelling reason why the KING-KAMBUF analysts view this current market pullback as an opportunity rather than a systemic crisis. The valuation compression is happening against a backdrop of double-digit earnings growth.
Okay, so moving forward, the calendar for the week of November 24th is a bit shorter because of Thanksgiving, but the catalysts that remain are absolutely critical.
Yeah, Tuesday is the last major day for fresh institutional data flow. We have major earnings from Dell, Best Buy, and Kohl's. These reports are essential barometers.
What are you watching for in each of those?
Okay, so Dell gives you the best immediate read on enterprise IT spending and how that AI hardware cycle is progressing outside of the giant hyperscalers. Best Buy and Kohl's, they're going to be the final pre-holiday readings on consumer sentiment and what the expectations are for holiday retail demand.
And then the most important data point, the one that's driving the entire consumer discretionary sector, that comes out right at the end of the week.
That's the Black Friday data. It'll hit the markets on Friday, November 28th. And this is the real-world test.
This is where the rubber meets the road.
Exactly. Are consumers opening their wallets aggressively, or are they tightening their belts? This data will either confirm the recession fears that have been driving this defensive rotation, or it could invalidate the rate cut expectation that powered that big Russell 2000 surge. The entire outlook for the consumer sector really hinges on the magnitude of that spending.
And finally, we have to return to the macro element that continues to drive all this volatility: the Fed.
That implied 45% probability of a December Fed rate cut. That is the most volatile pricing mechanism in the entire market right now. Any conflicting signal from a Fed governor, say a statement from the NY Fed's Williams that emphasizes fighting inflation over economic weakness.
And the whole narrative could flip.
Instantly. It could instantly reverse that recent strength in small caps and send the indices right back into consolidation. You have to be acutely aware that Fed expectations, not corporate earnings, are the primary short-term risk driver.
We have established a very chaotic context, and now we get to the core of this institutional deep dive. The actionable trading playbook provided by KING-KAMBUF.
Yes.
And this framework is defined by their T-KIF plus methodology, and more importantly, by these strict non-negotiable risk rules. Max 2% risk per trade and a minimum 1.2 risk-to-reward ratio.
This section, it really defines KING-KAMBUF institutional discipline. T-KIF 20 plus KING-KAMBUF. It's their proprietary method for identifying these high-conviction trade setups.
Do we know what that stands for?
Well, the details are proprietary, but the analysis implies it stands for something like trend-kicking impulse following entry. And it uses a 20-period look-back or a trailing stop. It's a system designed to catch sharp reversals or kicks within a dominant trend.
But only if the odds are in your favor.
Only if the risk-reward ratio is profoundly skewed in the trader's favor. It mandates that preserving your capital is the first rule. If that RR isn't met, you skip the trade, period.
Okay, so let's delve into Tier 1, highest conviction. These are the setups targeting that oversold bounce in the high-quality megacap tech stocks that took the brunt of the weekly pressure.
The first setup is Alphabet Inc., GOGL. And this isn't some speculative gamble. It's a very calculated attempt to capitalize on what they see as intact fundamental strength.
The setup here is a consolidation breakout near recent highs. The entry zone is pretty aggressive, but calculated, between $295 and $298, and the stop loss is firm at $290.
Right, which gives you a tight risk profile of 2.3%. It's just slightly over their standard max stop width, which tells you they have very high confidence in the technical support right around that $290 level.
And the reward potential.
It's substantial. Target 2 is set at $315, which represents a 6.4% gain, and this is where the methodology really pays off. The risk-reward ratio lands at an exceptional 1.2.73. That's the best RR in the whole high-conviction group.
And the rationale is just its dominance in AI and cloud.
Unassailable AI dominance and its cloud growth running over 26% annually. But the trade is contingent on the stock breaking convincingly above that $298 level, which would confirm the end of this consolidation pattern.
Next up in Tier 1, we have Amazon, AMZN. The setup here is an oversold bounce or a daily support test.
AMZN's setup is based on a key technical support level holding after all that selling pressure. The entry is between $220 and $224, with the stop placed tightly at $215.
So the risk is a bit higher here, 3.6%.
It is slightly higher than GGL, and that's just because AMZN generally has a higher beta. It's a more volatile stock. Target 2 is at $240, and that yields a very healthy RR ratio of 1.2.7.
And fundamentally, this is a bet on AWS and retail stabilizing.
It is. AWS resilience and the stabilizing retail segment. But, and this is an important warning in the analysis, traders have to look for a clear, strong reversal candle formation, a classic hammer pattern or an engulfing pattern, to confirm that the support near $220 has truly held before they enter the position.
So it's about patience and getting that technical confirmation.
You have to wait for the signal.
And finally, the most volatile name in the pack, Nvidia, NVDA. This company had a really tough week, even though they had another stellar earnings report.
And this is the classic accumulate on dip setup. The recommended entry is $173 to $176 with a stop down at $168. Given NVDA's, notorious volatility, the technical risk is wider here at 5.4%. But the conviction is that the selling was purely driven by valuation concerns, not fundamental ones.
The KING-KAMBUF report explicitly calls this the classic buy the disappointment trade. Can you explain that psychology?
Yeah, so when a high-growth stock delivers an outstanding earnings beat and fantastic guidance, which NVDA did, but the stock declines anyway, it means the street's expectation was already priced in, and probably then some.
It's a sell the news event.
It's a classic sell the news event. The selling is driven by large funds taking profits, or by huge institutional players who have to rebalance their massive weightings. It's typically a temporary compression. KMBU sees that 5.4% dip after earnings as an artificial opportunity for a technical bounce, and they're targeting $195. You're buying the weakness based on the conviction that the fundamentals are still rock solid and the technical move down was just overdone.
But that requires a lot of confidence and strict adherence to that $168 stop.
Absolutely, no exceptions.
Okay, so let's pivot away from that aggressive tech and look at the Tier 3 setups. The defensive and quality plays. These are for a lower risk profile, maybe more suitable for long-term allocation or patient swing traders.
Walmart, WMT, is the perfect example here of quality meeting a catalyst. The setup is a strong breakout that was fueled by the recent earnings. After it surged 6.5% on Friday because of their Q3 beat, the entry zone is from $84 to $87, with a stop at $82.
Which is a 5.2% risk, and the RR ratio here is still robust. Target 2 is ambitious, at $100, giving it 1.2.35 RR.
That $100 target, it implies real institutional confidence in Walmart's strategic execution in the face of inflation and its continued dominance in the essential retail space. And there's an added catalyst of its NASDAQ Q listing migration, which creates technical demand for the stock. This is a durable trade supported by dividend safety and defensive consumer spending patterns.
Yeah, and then we have the ultimate defensive powerhouse, Eli Lilly, LOY.
The setup here is just pure healthcare strength consolidation near highs. Entry is from $1,045 to $1,065, with a remarkably tight stop at $1,035.
That gives it a tiny 2.4% risk profile.
Which just reflects its defensive stability. But what makes LOY so unique is that its RR profile is incredibly skewed. Target 2 is set at $1,150, and that results in a phenomenal R ratio of 1.3.54.
Why is a 1 to 3.5 ratio so rare and so valuable in what's considered a defensive trade?
Because defensive trades usually offer lower reward potential precisely because they have lower volatility. To achieve such a highly skewed ratio on a stock known for stability, it means the analysts believe the secular growth drivers, namely that GLP-1 pipeline, are still fundamentally undervalued even at these current highs.
So for long-term accounts.
For long-term or retirement accounts, this setup is golden. You can compound your capital with minimal volatility, and one winning trade like this can cover more than 3 potential losses with money left over.
Okay, we have to briefly address Tier 2, the speculative high-risk play. The playbook does include Mobile Health Network, MNDR.
Yes, and this is the exception that's governed by the absolute highest caution. NDR offers the highest potential reward in the entire playbook, with an RR of 1.3.86, but that's only because of its explosive volatility.
That 83% gain.
Exactly. The mandatory high H risk warning is paramount. This trade is strictly, and I mean strictly, reserved for experienced, highly capitalized traders. And crucially, KING-KAMBUF mandates a maximum 2% position size on speculative names like this. You have to size your position so that if that $1.50 stop loss gets hit, you only lose a minute fraction of your total trading capital.
It's a volatility capture, not an investment.
Not even close to an investment.
Okay. This brings us to the section that I think truly separates the institutional approach from, the retail gambler.
Right.
The KING-KAMBUF risk framework is the non-negotiable prerequisite for any success.
The golden rules of discipline are foundational. The core rule, and it's repeated in every major section of this report, is the max 2% account risk per trade, coupled with that minimum RR of 1.2. And this isn't just arbitrary guidance, it is statistical survival.
Explain that. Why is violating that 2% risk rule so fatal to a long-term trading career?
Because by strictly limiting the dollar amount you can lose on any single trade to just 2% of your total account, the institutional trader ensures they can withstand statistically improbable runs of bad luck.
Right.
I mean, think about it. If you only risk 2% per trade, you would need to suffer 50 consecutive losing trades just to wipe out your account.
Which is highly unlikely.
Highly unlikely. But the moment you increase that risk to, say, 10% per trade, you only need 10 consecutive losses to be out of the game. That 2% rule is the statistical foundation of the entire KING-KAMBUF methodology. It ensures your longevity, and it enables the power of compounding to work for you.
And you have to adjust your position sizing constantly to adhere to that dollar risk limit.
Exactly. The report details very precise guidance on this. Your position size is adjusted based on your account value and the stop distance of the specific trade. For example, if you have a $100,000 account, your maximum dollar loss on any trade is $2,000.
Got it.
So if the trade requires a 5% stop, you can only buy $40,000 worth of that stock. If the stop is tighter, say 2%, you could buy $100,000 worth. The key is never violating that $2,000 maximum dollar loss threshold, regardless of what the position size percentage looks like.
Next is the stop loss protocol, which demands unwavering discipline.
And the protocol is stark. Execute your stops without hesitation. And crucially, never move your stops in the direction of a loss. This is what prevents a small, controlled loss from metastasizing into a catastrophic, account-destroying drawdown.
And for the volatile trades like MNDR, the report mandates using hard stops.
Hard stops.
What's the practical difference between a hard stop and a mental stop, especially when the market is in a panic?
A mental stop is a promise you make to yourself. I will sell if the price hits $20. A hard stop is an actual order you place with your broker. Sell this immediately if the price touches $20.
And in a panic.
In a market panic, which happens a lot in these high VIX environments, your emotional discipline just disappears. Panic makes you move your mental stop. You start hoping for a bounce. The KING-KAMBUF analysts note, and I love this quote, that mental stops disappear in panics.
Right.
A hard stop executes automatically. It removes your human emotion from the equation, and it ensures you adhere to that 2% maximum risk rule, guaranteeing your statistical longevity.
Okay, so once a trade actually moves in your favor, the report provides this meticulous three-tier profit-taking strategy. It's designed to protect your initial gains while still allowing the mega winners to run.
This is the structure of letting your winners pay for all your losers. Step 1. You take 50% profit immediately when you hit the first price target, T1. This instantly reduces your risk and it secures a material gain.
So you've paid yourself.
You've paid yourself.
Yeah.
Step 2. You move the stop on the remaining 50% of the position to your break-even point. This is crucial. You have now removed all downside risk on the rest of the trade.
So it's a free ride from there.
It's a free ride. Step 3. You trail the final 50% using a 2-3% trailing stop based on the price movement. This ensures you capture as much of a sustained trend as possible, and it adheres to that principle of letting your winners run. This system prevents any winning trade from ever turning into a loser.
The analysis provides a really rigorous final checklist. They call it the decision tree that you have to answer before executing any trade. It serves as a last layer of emotional and technical discipline.
The checklist is simple, but it is essential. Is the technical setup clear? Is the RR greater than or equal to 1.2? Is my dollar risk less than or equal to 2% of my account? And maybe the hardest question to answer honestly, am I emotionally ready for this trade?
It forces you to confront your own biases.
Your biases, your overenthusiasm, your fear before you commit your capital.
And finally, they list specific warning signals that mandate you should avoid new trades entirely.
These are your capital preservation rules. Avoid new trades if the VIX spikes above 40, which is extreme, illiquid volatility.
Yeah.
Avoid them if the RR is below 1.2, which violates the core methodology. And avoid them if earnings are scheduled within the next 24 hours.
Just avoid the coin flip.
Avoid the high-information asymmetry events. These rules ensure that your capital is only deployed when your mathematical edge is at its highest.
So if I'm a long-term investor, not a swing trader, what does this disciplined framework mean for my portfolio? How do I apply this thinking?
It connects the market pullback directly back to your long-term goals with a lot of clarity. The report emphasizes that this valuation compression, particularly in megacap tech, is creating rare opportunities in names like GOGL, AMZN, Microsoft, and Nvidia.
So it's a buying opportunity.
It is. The recommendation for the long-term investor is twofold. First, increase your defensive healthcare allocation by 2-3% immediately, capitalizing on the strength you're seeing in LOI and J&J. Second, use this volatility, this pullback, as a purchasing opportunity. The strategy is to dollar cost average into the weakness, to systematically rebalance into these high-quality names that have been unfairly punished.
So rebalancing into volatility is the prudent strategy.
It is the prudent strategy, not panicking out of the market. It's turning fear into a calculated purchase order.
That brings us to the close of our comprehensive deep dive into the reserve of KAMBUF Financial News and Reports Magazine, Weekly Market Digest and Investment Analysis from November 25th, 2025. This wasn't just a market summary. It was really an exercise in institutional discipline.
And we distilled 3 crucial takeaways for you. First, that VIX elevation to 23.85 is a huge warning signal. It demands disciplined risk management, wider stops, and the mandatory use of that 2% maximum risk rule.
Right.
Second, the fundamental sector rotation is clearly underway. It's favoring quality and defense, which is highlighted by those high conviction setups in Eli Lilly and Walmart, which offer these rare high RR setups in what are normally low volatility environments.
And third, the technology consolidation in megacap names like Alphabet, Amazon, and Nvidia is creating these defined, high probability swing trade setups with highly attractive risk-reward profiles. But only if they're executed within that strict TKIF 20+ risk framework.
For a final thought for you to consider, the market has priced in a significant 45% probability of a December Fed rate cut. And that's what fueled that dramatic Russell 2000 surge on Friday.
Right.
Now, if this expectation is shattered, say, if the Black Friday data next week is unexpectedly robust, or if other economic reports show the U.S. economy is far more resilient than people anticipated, how aggressively could that renewed risk-on sentiment for small caps reverse?
That's a great question.
And if we do see a severe risk-off reversal, the KING-KAMBUF analysis suggests that the stability of the S&P 500 would be severely tested. We have to recognize that the most aggressive forward models they're using are projecting targets around 6,500, but that's based on continued double-digit EPS growth.
And if that growth falters?
If those growth scenarios falter, what specific technical support levels, like that critical psychological and technical area around 5,700, would become the absolute necessity to watch for the market to truly hold a sustained bottom into the end of the year?
A crucial framing. The takeaway is crystal clear. Your success relies entirely on your execution of the non-negotiable risk management rules provided in this report. Because at the end of the day, discipline beats genius in the markets. We'll get you next time for another deep dive.